In today's video, we're going to talk about an often misunderstood retirement asset, cash. Now, as our team here at Safeguard meets with retirees, it's common to find many people fall into one of two extremes when thinking about cash as a retirement asset. On one side of the extreme, we find the common belief that cash is just an asset that gets eroded each and every year by inflation. You should do everything you can to avoid holding cash because you will just simply steadily lose more and more each year. Then, on the other side of the spectrum, we find retirees that believe cash is king. They may have 10%, 25%, or even 50% of their current wealth in cash. They believe cash is extremely liquid, which is important, and also is extremely safe. Now, the problem here is that both of these extremes are incorrect. And this shouldn't be surprising as most extreme views are incorrect. But I want to examine both of these views and show why retirees are often misled when thinking about cash. First, the common chart that leads people to think cash will constantly be eroded by inflation is the chart right on the screen. It shows the value of the US dollar over more than a century. More often than not, the US experiences inflation each and every year. Prices go up for a number of reasons, such as the government printing more money. As inflation rises, the value of your dollars falls. Since 1913, the US dollar has lost more than 90% of its value, and often this is used as a proxy to explain why cash is such a terrible asset. But the problem with this chart is it's simply just taking the value of a dollar from one year, decreasing it by inflation, and then looking at that value of the dollar the next year. But that's not really an accurate way to think about the value of your cash because the dollars you have earn more dollars. There's a positive nominal rate to cash, and that lowers and often sometimes eliminates the effects of inflation. Now, cash is a broad term. There are big spreads in yields that you might be earning on your cash. A checking account or cash account at a custodian is often an extremely low yield. If you're holding all of your wealth in this type of account, that US dollar chart we showed might actually be a better proxy for your cash. A much better option and equally liquid option would be a high yield savings account. Then, if you buy a money market account, you can earn a little bit higher yield beyond this, and all you give up is a couple days of liquidity because it will take some time to trade out of that fund and then receive your liquid cash. But at a snapshot right now, we can see that cash held in multiple areas is actually yielding higher than inflation. And this isn't just because I cherry-picked a snapshot in time. Often, in fact, more than 50% of the time, the return you can earn on your cash is greater than the inflation rate if you are investing that cash in the right place. In fact, going back to 1928, cash has had a positive return after inflation. Now, obviously, we can see periods where cash has lost substantially to inflation, but this gives us a vastly different view than the chart just showing the value of a US dollar and using that as a proxy for cash. And so the extreme feeling of allocating to cash and just we're simply flushing money down the drain is false. Cash over a long period of time has grown beyond inflation. We can also take an alternative view of this chart by looking at rolling 3-year returns of inflation versus cash. Now, the problem with investing in cash is that it's impossible to predict ahead of time whether the cash return will eclipse the inflation rate. If we highlight the periods in which cash trumped the inflation rate, we see both periods of interest rates falling and rising where cash outperforms inflation. And we also see the opposite of rising and falling rates where inflation reduced your cash purchasing power. Right now, cash is earning higher rates than inflation, but this largely hasn't been the case for the last 2 decades. My goal by showing you these graphs is not to give you the impression that you should hold large amounts of cash as part of your retirement plan. Cash is a tool that should be used in certain places, as we will discuss. My goal is to simply show you that cash isn't a tool that automatically loses to inflation each and every year. More often than not, the real return on cash is positive. Now, often retirees will use cash for safe withdrawals in retirement, and this is great. In the accumulation phase, volatility or ups and downs in your portfolio can be a good thing, allowing you to dollar cost average and buy assets when they're at a discount. But in retirement, volatility can drag down your portfolio in the form of sequence of return risk. For instance, if you have a 100% stock portfolio and 2008 happens, causing you to lose half of your portfolio will need to double or rise 100% to get back to break even. But let's say you're in retirement and withdrawing from that portfolio, and those withdrawals causes your actual reduction in your portfolio to be a 60% drawdown. Well, now to get back to break even, you need to make 150% on your money. Basically, losses will hurt more than gains help in retirement. So cash is one of those tools that you can use to stay liquid and avoid some of those big portfolio drawdowns. But cash is just a fixed income tool on a very short time horizon. The money you put in cash provides you with 100% liquidity, but you don't need 100% liquidity with all of your safe assets. And so you shouldn't hold all of your safe assets in cash. If you need $50,000 from your portfolio this year, you're probably going to need something like $50,000 next year and $50,000 the following year and so on, just simply adjusting to whatever inflation rate you're using. Well, because we don't need 100% liquidity, we are able to lock up some of our money for longer periods of time and earn a higher rate of return. In most scenarios, retirees will be facing what's called a normal yield curve. This means the longer you are willing to wait to receive your interest and principal, the higher return you're likely going to receive. In a hypothetical scenario, you might be earning 4% on your cash right now, but a 4-year treasury bond might be earning nearly 4.4%. Well, with the income we need in, say, 2028, we shouldn't just be keeping that income in cash for the next 4 years and simply just earning 4%, when we could otherwise buy a 4-year treasury bond, hold it to maturity, have it mature in 2028 and earn 4.4%. And so this is why the extreme view of allocating substantially to cash is also a wrong view to have. Let's take a broader comparison using certain assets on a wider spectrum in the context of safe withdrawal rates. Now on the screen, I have a situation of someone who is 62 years old, has a $2,500 per month Social Security benefit, and we're planning for approximately a 30-year retirement. Now, we are defining safe withdrawal rate in this context as the worst case scenario historically, given this person's situation. If we look at someone being fully invested in cash and no other assets, the amount they can afford to withdraw from their portfolio is not great at less than $4,000 per month. And this is primarily because in the worst case scenario, there ends up being a very high inflationary period where the real return on cash is pretty substantially negative. However, adding stock exposure to a cash position helps greatly and increases monthly spending by nearly $1,500 per month. As a comparison, I show an alternative of 50% in cash versus 50% in bonds, just to prove the point that cash should really only be used for high liquidity purposes. Beyond short-term liquidity, we should be aiming for higher yields, which bonds can provide. Then we have the extreme view of 100% in stocks, which is better than 100% in cash, but again, I use this here to show that we should generally avoid the extremes. Now let's summarize this video with some rules or general takeaways around cash. First, cash is not an atrocious asset some make it out to seem, but we should primarily be using cash for only short-term expenses. Now, if you have an expense that's a variable expense, such as you might be buying a new home anytime between now and the next 3 years, I don't have a problem with keeping a little bit more in cash for having a little bit extra liquidity to make quick decisions. Beyond this, however, it's suboptimal to carry large amounts of cash. Now, if you have a big safety margin in your plan, like maybe you have $3 million and are only spending $8,000 per month, it's not going to ruin your plan to have a little bit excess cash. But just know there are better options if we're just focusing on the quantitative side of things. And if you're someone who's been over allocating to cash because you're nervous about investing, or maybe you're trying to gain some extra peace of mind because you just began retirement, know there are better options. A better allocation strategy may give you the best of both worlds, peace of mind and better growth. Here's a video showing what I mean. And always remember, you don't need more money, you need a better plan. Thanks for watching. We look forward to seeing you in the next video.